Wow, I think I might be live. Welcome, welcome. We are about to hop right on into this, and we're going to do a little bit of like a market review, see what's going on in the markets beforehand. Um, and obviously, if anyone has some comments and questions and stuff, we'll start talking a little bit and have some fun today. Go over. We have the Federal Reserve about to announce the federal funds rate decision. Um, we've had a nice amount of things happen over the past 24 hours in preparation for this moment. Obviously, there are a lot of things to consider regarding whether or not essentially the Fed is actually going to cut by 25 basis points today or maybe even 50 basis points. Uh, Markets are telling us that it's going to be a 25 basis point cut. But today it'll be super interesting because uh, we need to hear now what Powell actually has to say about this, because not only are we in a position where we have new things going on, but also we now need to see what's going to happen in the future, right? Because now we're taking a pivot in the stance. So we're not at a holding pattern anymore. We're starting to actually turn around and potentially start to lower rates and loosen policy. And in that scenario, we need to know what the future rate path is actually going to look like. So give me just a second because I need to actually make sure that I'm live. This is my first time doing this, so I have no idea. I could be talking into a void at the moment. But anyways, yeah, so we'll dive into some charts in a second and see what's going on. Oh, okay, cool. People are watching. Nice. Oh, cool. Hi. Oh, that's exciting. So yeah, I'm gonna hop into some charts and then we'll talk about what we're seeing, and then I'll also hop into some news after that. And yeah, I'm not sure how we want to do this. I think obviously when Jerome Powell goes live, we'll actually listen to him and hear what he has to say, and see if we can pick out anything about what he's saying that we find interesting. And that's how I'm gonna take it. We're gonna kind of just like free. We're gonna just keep it real free and loose here. We'll see what we can accomplish. So let's see what I got. Not that one, but this one. All right. So a lot of people here are Bitcoiners. So first thing that I'm looking at here is the Bitcoin price. As we can see coming into today, well, in general, we've kind of had a little bit of an ascent, but also a nice little bit of a rejection right here. We're really not doing anything yet. It's clear that we're in a bit of a holding pattern. And we'll look at the NASDAQ in just a second, and the S&P 500 as well. But ideally, we'll get some sort of a reaction here. I think, I'm going to be honest, the most likely scenario is that everyone has been expecting that we're going to get a rate cut. So when we get a 25 basis point rate cut, it's not necessarily going to be some surprise to the market to the upside. It might just be like, oh, okay, yeah, we already digested this news and probably will sell off. I'm not saying that I know what's going to happen here, but I wouldn't be surprised by that. Also, when we look at the NASDAQ, let's go ahead and pull it up real quick. It's kind of already sliding. And to me, that's pretty telling of what it is that we're probably going to see for the continuation of that movement. Also, you got to think we're bouncing off of the fact that we've been at all-time highs. Like yesterday was literally an all-time high day. By the way, when I look at stock market charts, I'm usually looking at the futures prices. We could look at QQQ. Why is that being weird? Oh, because I'm on futures. That's why. Okay, so we could look at the QQQ. It's going to pretty much tell us the same thing, but just a little bit less data because of the fact that it doesn't trade 24/5, and also or 23/5 technically, and also it's an ETF, right? So it's a totally different instrument expressing the same concept of the NASDAQ 100. So I like to use the NQ when I'm looking at prices. Also, for anyone who doesn't know, I'll go ahead and let you know now, I actually do trade in the futures market. So today I'm probably not going to trade just because I'm going live for one, and also because usually trading on FOMC is pretty rough. And not only that, but we're actually going through a pivot. And so this entire week I've been on the sidelines, just kind of like letting charts develop, not trying to make any active moves, just being aware of what it is that's kind of happening in the markets. And like I said, after we've already gone up here and taken out this all-time high and created a brand new high, I'm not going to expect us to continue to go any higher. But, you know, hey, we always kind of have to just wait and see what happens. So yeah, this is just a quick analysis of what's going on. This is the hourly chart on the NASDAQ. We've seen that prices are sliding. And guys, I'm going to get into the news in just a second. I just wanted to kind of go ahead and just at least take a look at the charts. This is really my first time digging deep into what it is that I'm looking at. So let's look at the S&P 500 as well. Pretty similar pattern. It looks like we have a nice opportunity to slide lower here. I'm not going to lie to you. In the style of trading that I use, for everyone once again who doesn't know, I actually trade ICT. When I look at this right here, I see what we call trend line liquidity. So it wouldn't be surprising if there's a lot of stops that are resting down here that the market would like to go out and take either today or at some point in the near future. So I think another thing that we could look at really quickly is the Dow Jones. Let's see how it's doing. It's doing okay, poking its head up a little bit. And let's lastly look at the Russell. Okay, the Russell 2000 is small caps. So it's 2000 of the small caps, which I think in stocks is like anything that's under $1 billion or something like that, or maybe even under 100 million in market cap. I'm not even 100% sure. But the Russell has actually been performing really well since the lows this year, which says a lot for risk assets. It basically says that there's a nice amount of, okay, when fund managers are looking at how they're going to allocate risk, they're gonna, when it comes to equities and risk on environments, you're gonna start off with like the basics of the S&P 500. Like that's the thing that if I'm gonna put risk into the equities market, I know for a fact I have more faith that those stocks are going to perform. Then you have things like the NASDAQ, which can be a little bit more risky. Sometimes the NASDAQ will actually outperform, mostly because there's a higher concentration of tech companies that are growing at faster rates, or at least the prices of those companies is going up at faster rates. Now, when it comes to the Russell, these are smaller companies. And so when we're looking at these smaller companies, basically we're putting on a little bit more risk when we're investing in them at an institutional level. So that's kind of the way that we look at the Russell. We're saying, hey, there's kind of like excess money potentially going into riskier assets. And you can use this as a way to look at, okay, if this is flowing and going higher, then you would also expect the same kind of a thing for any other risky assets such as cryptocurrency or Bitcoin. So that's a quick breakdown of what we're seeing in the markets on the equity side. We also have gold. And for anyone who's been paying attention, gold has been on an absolute tear over the past couple of weeks, which is really cool to see because we were in a holding pattern for quite some time. Once again, guys, you know, for anyone just now coming in, we're just doing a quick overview of what's happening in the markets, but I'm going to dive deeper into the actual news and stuff like that. I just wanted to kind of like let people come in, also hear a little bit more from you guys, see what it is that you guys want to hear about, and just do a quick update and overview of what's going on. So let's see how long gold was in a holding pattern. Gold was in a holding pattern for 85 days. There were people that were actually doing very well in this range, by the way. I personally was staying away from this, but that's, 3 months almost of moving sideways, to be fair, after quite a run up that it has had before then. So I'm going to zoom out and go to the weekly chart really quickly because, gold has just been going crazy since right around here. It looks like February 2024. Huge gains in gold. And certainly some really big opportunities that have come out of that. And I'm not going to be surprised, I'm going to be honest with you, if gold continues to move in this kind of a manner over the next 18 months. So a 63% gain since early 2024. This gold has gone up to all-time highs and well beyond those levels. By the way, once again, I'm looking at the futures price of gold right here. So that's what GC is, if you can see in the left-hand corner. I'm going to try to look and see if I can see some comments. I'm not sure how to see the comments. If you're here with me, let me know. And then I can hopefully start to respond to some comments as well. Yeah, I don't know how to see the comments. Okay, so I'll figure that out. But in the meantime, I think we can start to transition into looking at some of the news. But wait, because I want to show you guys something as well that I look at. So when you're looking at gold, you can look at XAU USD. And this is more of like the spot price of gold and not the futures price that I was just looking at. And then what I also like to do is I like to look at the European gold versus the euro. It's going to be pretty similar, but what you can do is on the smaller time frames, you might be able to see when there's some divergences between the price between the gold price in dollars and the gold price in the euro. And that can also just kind of give you some ideas of like on an international level, how gold is performing. And you can look at the price of gold in any other currency as well, I believe. So just something to think about. And then we have silver. Once again, if you're just coming in, just very quickly going over what's happening in markets, and then we'll dive into the news and look at maybe some other information around what's going on. So, all right, so silver is just now kind of finally getting a real push. Like, I'm going to zoom out to the monthly real quick. It has not reached its all-time high yet. So just keeping an eye out on this. It's definitely looking like it wants to go for these highs up here. I'm not going to be surprised if we get there in the next 18 months. And it definitely has some catching up to do versus gold. So just something that I'm looking at. Let's see what's happening with oil. Oil has been moving sideways. We had a big run up after obviously 2020. This is on the monthly chart, guys. So this is long-term stuff that we're looking at. But oil has been pretty much moving sideways ever since late 2023, it looks like. So not a whole lot of action here, even with a lot of the geopolitical movements and that we've had over the past, let's say 8 months here. Really not too much going on for oil, which is stabilizing for the global economy and definitely something that's, keeps things in check. Let's see, what else do we want to look at real quick? Last thing I'll look at is the dollar index because I haven't looked at it lately. As you can see, I have some markations out here of like how the dollar was performing during the bull runs. I will clean that up in a second. Anyways, so, okay, finally, the dollar is breaking down. I've been calling for that for quite some time inside of my Patreons for anyone who's been around. And it's just been being really funky about this. This was a really tough squeeze right here for anyone who was short the dollar. But right now, here's the thing. So far this year, we've come down more than 10% really from these highs. The dollar index is down. So it's like, all right, we're down over 10% in the dollar index. And the stock market is pushing off higher. Crypto is starting to push off higher. And in reality, I'm expecting another leg lower here, right? I'm expecting us to kind of probably get down and even, into the 90s. I'm not going to lie. And I'll show you guys a little bit of just some history. It doesn't mean anything in particular, but something that I think is interesting to look at is how the dollar also performed during the current president's first term. What we had was big tariff talk, right? When he first got in office, I don't remember exactly when it was. It might have been, I think, early 2016, he probably got in office. He started talking heavy tariff talk, right? Right around up in here. What does the dollar do? It makes a huge run up during that time. And then what happened is it fell lower. Took a little bit of a breather, and then it fell lower for that second wave. So I could be off on my dates here, guys. Hopefully I'm not. In that time frame, right? We also had the 2017 bull run that took place. So just something to keep in mind. As you can see over here in 2020, we didn't have that same kind of inverse relationship between the dollar index and crypto, but that is something that happened. And I know everyone here is not a crypto person, but this is something that we're looking at. So right now, it's like, okay, well, we kind of have a potential for a very similar scenario because we've had our guy come into the office here. What happened? Markets pushed up on the dollar very high. And then we started to roll over a big leg down lower than these lows that we had set in the market before. Now, what I'm looking at this as is a little bit of a reaccumulation, a little bit of a breather that's being taken until we actually make that second leg lower. And this time, I'm not going to lie, it looks like we could, be a little bit more dramatic about what that looks like. So just for some clarity here from these highs back in January, where are we at in the dollar? We're down 12% in the dollar. Okay, so these are dramatic moves. It might not look like a whole lot of a big deal on that chart, but this is pretty wild. Last thing we'll look at, and then I'll promise I'll actually move on to start talking about the actual news, is rates. So we have the 10-year here hanging out at around 4%, not doing anything major. Let's look at the 30-year. 30-year also kind of hanging out, but the problem here is that the trend over the longer term is absolutely going up. So from these lows back here in 2020, we had 0.75% on the 30-year, and we've had a huge run up. And with that, bond prices have declined. Now, it looks like we're obviously about to start an easing cycle. So we're going to start getting rate cuts in the front end, and hopefully, right, ideally, at least from the administration's perspective and as well as the Fed's perspective, I guess the Fed's not really supposed to care about long end rates, I guess. The long end rate will come down as well, along with the front end rate. So that's just where we're at. Let's start talking about the news. Let me get in the other direction here real quick. Okay, so pardon that. Let's see. Okay, so one of the things that happened last night, by the way, everyone, is that we had Trump's pick for filling the lady who stepped down from the Fed board, Stephen Moran, who is also his economic advisor. He was actually confirmed as a Federal Reserve governor last night. So with that, what CNN says is that means that he's actually going to get the chance to vote today. So let's read this article real quick. Steve Moran, one of Donald Trump's top economic advisors, on Monday was confirmed by the Senate to serve on the Federal Reserve's powerful Board of Governors, hours before the Fed's two-day monetary policy meeting begins. So the Senate voted 48-47 to confirm Moran. We had this senator from Alaska who was the only Republican to actually vote against his confirmation. Now he was sworn in, I believe, this morning, and he will immediately be one of the 12 officials voting on interest rate decisions moving forward. So he was nominated to fill the remaining time in former Fed Governor Adriana Kugler's term, which was set to expire in January 2026. So he says that he will also not resign from his influential post at the White House while he serves on the Fed's board instead of taking unpaid leave. Interesting. I hadn't heard that yet. So I guess he's going to be an economic advisor for Trump and sitting on the Fed board. That's kind of wild. I'm not going to lie. Okay, interesting. So let's see what they say. The Fed, by law and tradition, has remained independent and nonpartisan. Now, for the first time in its 111-year history, a member of the Fed's Board of Governors is also technically an employee of the president. Right. So, because that sounds crazy. All right. So during his Senate confirmation hearing, Moran said he was advised by an attorney that doing so is legal, and he plans to carry out his duties as a Fed governor independently. Okay. Fair enough. I think, we're all humans. So in reality, can we really separate our duties when we have two different jobs at once? Probably not. But let's read the rest of this article. Moran's confirmation comes at a pivotal moment for the Fed. The U.S. labor market is weakening as Trump's widespread tariffs start to push up some prices, simultaneously threatening both sides of the Fed's dual mandate, stable prices and full employment. So this has been the big thing, right, that's happened over the past 3 months or so. We keep on getting updates on what's happening with the labor market, and what we're getting is these revisions saying that basically we've had reported that there's like 1 million more jobs in the economy than what there actually were. So I think that happened once in August-ish, that we had a revision for what happened in July. And then I think like this last month's job report, we had that even back in like May or something. I could have gotten those dates mixed up. But basically throughout the year, there's been over 1 million jobs that have been not properly reported. They've been reported to have been there, but were not. People were not working these 1 million jobs that we thought we had in the economy. So with that said, the unemployment side of the Fed's mandate is not necessarily being met the way that we thought it was. So while the Fed has been holding instead of lowering rates to try to ease conditions, it turns out that actually all of the jobs in the economy have not been as strong as we thought they were. So now, while that's been happening, we've had sticky inflation. We've had inflation at around Inflation's been at about 2.9% was the read that we got last, last CPI report. So 2.9% in the headline CPI inflation. The core PCE, I don't remember exactly what it was, but basically it's sticky. It's at a very steady level. Let's just pull it out. Let me just pull it out. We got time, right? So the site that I like to use for my economic news, everyone, is called, let me see where we're at. It's called Forex Factory. So on here, basically you can get your news for what's happening around the world throughout the week. I always check this on Sundays to see what's going on this week. Obviously, we have the federal funds rate today and the FOMC statement that's going to happen after that. I realize I've been talking for quite a bit. We're coming 11 minutes until we actually get the rate decision. And you can see right here, the forecast for that decision was 4.25 and the previous was 4.5. So we'll get the actual number right here, and it's going to be green if it's anything that, well, actually, I'm not going to say because the green and red is based upon what impact it's supposed to have on the dollar. And I don't know how they come up with that, but it tells you in this section right here. So anyways, but we came here to look at CPI real quick. So let's look at CPI, and I'm just gonna use this because I know that it was last week. Oops. Okay, so CPI year over year, let's see here, was at 2.9% this month. So here's a graph of what CPI has been doing. So obviously, after 2020, we had a huge easing of conditions, and that led to what we can call incredible inflation. It got up to around 8.9% at its peak for the CPI. Since then, we've had things kind of calm back down, but honestly still stay a little bit above the 2% level. Now, technically, the 2% level is for the core PC, and we'll look at that in just a second. But just kind of like to get an idea of where we're at in the inflation numbers. And so, when you look at it from a historical perspective, it's still pretty high. We still have pretty high inflation, even though we've calmed down from the 2020 crisis that we had and all of the money printing and all of the easing that was done during that time. So, it's kind of hard to say that we're really coming down in inflation. We're bouncing around at the moment. And then we have also the tariff situation, which we've been debating, or there's been a debate around whether or not that's going to be something that is, what do they call it, transitory, or the point is it going to be a one-time price level shock from the tariffs, or is it going to be something that's going to lead to persistent inflation over time as well? That's been the argument. That's what Jerome Powell has been talking about. I think he officially pivoted in the last meeting where he said, actually, we think it will be that one-time price level shock and that things will be fine from here. And that justifies him being able to say, okay, from this point forward, now we can actually start to ease and cut rates. I'm realizing I'm a little bit bigger than I need to be. Let me. Sorry about that. Okay, cool. So let's look at the PCE now. I'm not sure the best way to find it. So let me maybe do this. Yeah, I think that does it. Okay, so here's the PCE on a month over month. Can I get it on a year over year? Maybe not. Maybe it's only a month to month on here. Okay, so zooming out, as we can see, core PC is also, so I need to find the yearly level because that's not going to cut it. Huh. All right, I'm going to find this. Okay, so on Forex Factory, by the way, you can set your filters for what it is that you're trying to look at. So I'm just going to uncheck everything that's not exactly what I'm looking for and then go back. I'm sure there's a much better way to find this information, but this is what I'm going to do. I'm going to put red folder, inflation in USD, and from there, I think I'll be able to find this much more fast. All right. So, okay, core PC, month over month. There's no year-over-year read for the PCE. Huh. Interesting. Okay. All right, fine. So, either way, if we look at it, right, the PCE has not been very kind. All right, it's also been pretty elevated throughout this past year and a half, at least relative to historical standards. The idea is you want the total year over year, I believe, to be around 2%. So if you're getting month over month at 0.3, it's going to put you at essentially 3% over a year, a little bit over that, 3.6%. So that's not obviously exactly how it works because you have to take it in the month by month, right, and actually add it up and see what's going on. But yeah, I'm actually kind of surprised that there's not a yearly read on that. I either don't know what I'm doing or just didn't know that that's not how they calculate it. So, yeah, so that's some of the economic data. I think let's kind of take a look at what some of the other news sources are talking about. We've got the Fed expected to cut rates and update views on Trump's plan with new projections. So that's another thing here is we're going to have to look at the the rate path going forward. So when we get the dot plot, we will have an opportunity to see exactly what it's looking like on the future of rate cuts. So I actually don't pay for Reuters. I'm gonna have to pay for that. So I'll do that after this, and that way we can keep that a little bit more smooth moving forward. But we've got 5 minutes here until the actual rate decision comes out, and then we'll have a chance to actually listen to what our guy Jerome Powell says 30 minutes after that. So I got to figure out a way to get access to the chat, because if I don't have access to the chat, then I'm just talking, and that's not the point of this at all. So let's see. I'm actually going to put it up on my phone. Waiting around for the Fed won't get you rich. I totally agree with that. Let's see. Let me pull up some charts while we do this, so that we're not just looking at this wonderful man. Okay, so waiting for the Fed won't get you rich. I totally agree. Let me actually respond to that, because I think it's important to know that first off, we're not sitting here trying to get rich. All right, that is not what I'm trying to do right now. If that's what you guys are trying to do, then it's probably not what we're trying to do at the moment. We're trying to understand what's going on in the economy. And on top of that, right, start to develop plans of what we're going to do about that. So hopefully that's what you're here for as well. Let's see. What's up, Off Paths? I'm sorry for taking so long to get to you. You know, it's taken me a while to realize that I've got some people in the chat. Understand the protocol and verify. I agree with that. Let me pull up something that's a little bit more relevant to everyone so that we can see what's going on. Bitcoin, by the way, is like, let me see. You know, it's very strong structurally here. Like, this is no joke, really strong. I think, you know, we get scared, we see the little pullbacks, and we, you know, make a big deal out of it. But it's like, I think, you know, Bitcoin's in a really good spot. And even if it needs to come down a little bit lower first, which is a little bit of what I've been talking about inside of my private communities, I think we're still on a good path to have some big gains by the end of the year. No specific price targets coming out of me in particular, but that's kind of what I'm expecting. So let's see. My man, he said, yo, Jamin said, how we feeling about this meeting? You know, I'm definitely excited to see what happens, because in reality, I think that we could get surprised. You know, that would be wild. That's like the wildest outcome, is that we actually get a 50 basis point cut and people are just like, oh my goodness, and then markets just soar. I highly doubt that that's what's going to happen today, but it is a possibility. So let's keep that in mind. Let's look at the CME Fed Watch tool. That's what we can look at real quick. Because basically I wrote to my community this morning about how technically there's a non-zero chance of us actually getting a 50 basis point cut. It's gone down since this morning. It was at like, I think 5.9% this morning, but it's actually down to 4.2%. So by the way, this is the Fed Watch tool. Essentially what this is this allows you to give this is based upon what traders are actually trading in the futures market on the federal funds rate. So there's a specific ticker that traders can trade on for what they believe the future of the federal funds rate will be. And this tool is basically the CME where those trades are taking place, actually telling us what the probabilities are of certain cuts based upon what traders are saying. So this isn't like probabilities of what must happen. This is just what traders are pricing in. So this also tells us essentially, if we did get that 50 basis point cut, how many people would be off sides. That's really how you really want to look at this tool. But anyway, so we can see right now 4.2% chance of this being what happens in this meeting, of it being a 50 basis point cut, but a 95% chance that we have a 25 basis point cut. And the thing is you know, there's no cut anymore, right? That's gone. And I think that happened once we had like that first major revision in the jobs report. I think at that point it was like solidified that we would get at least a 25 basis point cut in this meeting. And also the other thing, okay, so by the way, so the contract that I'm talking about is ZQ. The ZQ is that federal funds rate contract on the CME, and we can like come over here so that you can see what that looks like, right? So we'll type in ZQ, the 30-day federal funds rate, okay? And this is that contract that traders are trading on. So I've never watched this during a Fed meeting. Maybe we could keep that pulled up and see like what ends up happening. Once again, if we get that reaction of a 50 basis point cut, it would be a lot of fun here. Oh, it's time. Sorry, I'm talking. I'm yapping, y'all. Let me update. We know what it is at this point. There was a live countdown and we just missed it because I'm over here yapping. I'm over here big yapping, y'all. I don't even know how to fix my filters. That's how big I'm yapping. All right. Okay, so 25 basis point cut was the official cut. We can see right here from the actual. So that's what it is. Let's see. And that's why we were seeing some movement over here, by the way. Let's look at how everything is reacting, y'all. We'll definitely get a little bit of a post reaction from whatever Jeromey Rome Powell has to say. But we could also see a little bit of an immediate reaction. So, okay. So the NASDAQ, which is my favorite thing to look at, by the way, if you haven't considered or figured that out, by now. NASDAQ pushed up, it looks like right before, I'm going to be honest, that's super bearish for it to kind of like have that kind of reaction. Looks like it might roll over from there, but we'll see what happens. Oh, yeah. Okay, so here's what really, oh, man, I can't wait to start talking about trading with you guys. Who in here is an ICT trader? Let me know in the chat if you're an ICT trader. I'm super, super curious. Oh, we've got a lot of people commenting. Let me see what's going on. Hold on. Yeah, speech at 2:30. Yeah, we'll definitely tune into that, no doubt. How long left? I messed up. We're live. We got the decision. It's a 25 basis point cut. I wonder how this affects the Fed tool watch tool also. It should push us forward to the next meeting, but let's see what it does. Are you guys even seeing what I'm seeing? You're not even seeing what I'm seeing. Oh my goodness. Oh my goodness gracious. Oh my. Okay. Well, we were looking at the Fed watch tool. We were looking at the charts. We were looking at ZQ. I don't even know if you guys heard or saw any of that. The ZQ is the contract that is the 30-day federal funds futures contract on the CME. So that answers hopefully that. I say hit the breaker then down. Yeah, so I got some ICT traders in here. That's what I'm talking about, dude. I'm super pumped about that. That's what I'm talking about. Okay, yeah, low resistance liquidity runs right here. Let's go. Let's go. I am Amar. Bigfoot Stepper is also RVSIP. Omar says absolutely not. We love to hear it. If anyone hasn't noticed, I actually started a new show with Ben Leavitt. We're doing memes and markets, and we're going to talk about ICT for sure over there because there's like a big problem with people hate them and they hate the whole concept of ICT and all this. So we'll talk about that over there in a future episode. It looks like S&P 500 wants to go. I'm not going to lie to you guys. So we'll see how that goes. ICT baby, Deadpool groovy. Let's go. ICT is the GOAT, says Bigfoot Stepper. Praise Joseph said he's full porting Solana 100x. Let's look at Solana real quick. All right, this is fun. I'm not going to lie. We're going to have to do this more often. Okay, so ICT, the Inner Circle Trader, is a figure, and he claims to have created these concepts, and he calls these concepts ICT concepts. And essentially what it's about is like kind of how markets move. All right. He kind of said that there's an algorithm that moves markets, and essentially this is how you can understand this algorithm a little bit better and use it to be able to make profits in your trading. Hopefully that basically answered the question. And yeah, Bigfoot Stepper, we're gonna have to chat. We're gonna have to keep on. I got to hear more from you because I always do my best to tell people about the Inner Circle Trader. Someone else said smart money concepts, right? So smart money concepts is essentially another way of calling ICT. It's like someone out there rebranded ICT's work and called it Smart Money Concepts, or SMC. So you'll see that as well a lot. There's like Casper SMC and all these different gurus who talk about that stuff. And I didn't mean to call him that. He's a figure and a trader who teaches people about ICT and SMC, but it's pretty much the same thing. ICT is just kind of the original author, or at least observer, I think it's better to call him, of these concepts. And and like ICT rants too much. Like, yeah, I'm not gonna lie, like he's not the best person to learn from, but at the end of the day, I think you should start there. Like the Bigfoot Stepper said, he said, go back, search him up, and look at his oldest videos first. It's like the one thing about ICT that's amazing is that you can learn like the philosophy of it all, I think, very well from him. And then from there, start to learn the actual strategies probably somewhere else. But anyway, so I just use PD arrays. ICT sucks. Yeah. And that's another part of it, is like, are you saying ICT the person sucks? Or are you saying ICT's the concepts suck? So anyways, I'll have a whole conversation with Ben about that. ICT is not the originator of these concepts, right? So it's like, listen, originator, observer, promoter, it doesn't really, that's not what I'm necessarily thinking about. So thank you, PTP. Said 100K subs already. Holy moly. I appreciate your words. We are almost there, not just yet. And at 100K, I plan on doing a release on some of my favorite books. So if anyone's interested in that, definitely let me know. Let's see. So Solana is doing really well, by the way. I forgot to talk about that. Hopefully I'm properly showing my screen again, because I've been getting caught up. All right. Yeah, so Solana's been performing very well relative to a lot of the other altcoins throughout this kind of, how would I say, this push back up towards all-time highs. So Solana is leading the way. For that guy that's going 100x long Solana, good luck to you, sir. I don't necessarily recommend it, but that's that. So I don't really care for semantics. The way I learned these concepts had nothing to do with Michael. Fair enough. I think it just comes down to the idea that, like, most people got it from him. It's crazy because I found his content in 2016 and I didn't know anything about it, right? I was in high school and I was working on like totally separate ventures, and I had just seen it. I heard one thing that he said about like trend lines, and forever I was like changed, because I didn't start trading until many years later. And in fact, 2 years ago, I started trading seriously. And what happened was I thought back to myself. I was like, because I even was teaching people that idea that, like, I don't like the idea of trend lines. Like, the market moves, right? When you just think about time, right? And like when you're drawing a trend line on these charts, right? Time moves linearly in these markets. So in these charts. So for you to just kind of like cut through time, right, by trying to look at a trend line in the market, I'm like, that doesn't really make sense to me. You can't just like warp the time aspect of things. And you guys are gonna, you can come back to me and say this is wrong, it's inaccurate, or whatever. But to me, there was a logical thing of like, something about a trend line doesn't necessarily make sense, and it stuck with me. I was even going to schools and like talking to kids about trading and stuff, and I was like talking about some of this. And 2 years ago, late 2023, it hit me. I was like, I need to go and figure out who this was. And I looked him up, and at this point, he had blown up. He's got like millions of followers now. So anyways, let's come back to looking at what the charts are saying. And from that point forward, like, I was just like, all the way in. I was like, oh, okay. I found this guy. He's huge now. Like, I don't know what he was at when I found his stuff, because honestly, like, I kind of just got access to one of his little courses from people online, but I didn't know who he was or anything. I just remembered the thinking and how different it was, and now all of a sudden he's got millions of subscribers. So that's kind of been a little bit of my journey with ICT. And then Keith, look into GAN, says Bison. I've heard about GAN. I've heard about his whole story as well, or not his whole story, but I've heard about the background. There's definitely something there. I don't look into it super deeply. Yeah, let's look at the total. Good stuff, Bison. Let's look at the total market cap in crypto real quick. Oops. So, yep. It's flirting with 4 trillion. So, let's zoom out because I'm super hyper zoomed in. So yeah, the total market cap of crypto is looking like it wants to go. Once again, I mean, that's a really strong push that we have here after this kind of consolidation that we've had over the past few months. Um, I like to look at total minus Bitcoin and Ethereum and minus stablecoins so that you can get a bigger picture of like the altcoin market. I guess is all I'm saying when you're looking at altcoins. So far, we've already hit the all-time high in the cryptocurrency market cap back here in essentially November 2024 when we had that big run-up in Bitcoin, and even some other altcoins were making some moves at that time as well. But we haven't had like a real big blow off top from that previous level of around 3 trillion. So we're sitting here at 3.7 trillion, or excuse me, we went up to 3.7 trillion, had a big pullback, and this was brutal for altcoins, by the way. And now we're finally actually pushing back out and making some new highs in the total cryptocurrency market cap. But what I like to look at is total 3ES, which is going to take the total market cap minus Bitcoin and Ethereum and minus stablecoins. Now, the reason that I'm looking at this and trying to use it as a way to look at also kind of like where we're at in the cryptocurrency bull market is because essentially we have like ideally there will be some sort of an alt season, and that can help us to kind of track where we're at in the total market cycle. And as we can see here, we still haven't even created a new all-time high throughout this entire cycle. Now, it doesn't have to be that way. It doesn't have to be that we create a new high throughout the altcoin, throughout the entire Bitcoin market cap. So this is just something that I like to take a look at, though, regarding if we get there, then that's what could happen moving forward. Man, Tyler Hill, he says, keep the ball rolling, my brother. Absolutely banging first stream. Wow. Thank you. I really appreciate that. That means a lot to me, man. And thanks for everything that you've been doing for me as well. Tyler Hill, guys, is awesome. I'm sure a lot of you guys already know him. I've seen you guys talking about him in my comments as well. All right. So ICT is mainly based on the theory that is based on assumptions rather than legitimate data. Okay. I think that might be fair to say. And then come on, show us your book list. Yeah, we'll definitely get that. Anyone mess with Credify? I'm not familiar with Credify. Lauren says, let's go, Tyler. Let's go. Let's go. Any book recommendations for understanding macroeconomics? Yeah. I'll give one out that I liked a lot. It's Central Banking 101 by Joseph. The Fed guy. I don't know if you guys know the Fed guy, Joseph. Joseph Wang. He used to work at the Fed, and he actually has a really cool channel as well. In case you haven't heard of him, he does like a weekly update at the end of the week, and it's really good. It helps to break down like for people who aren't super versed like myself and many of you guys, like how what's happening in the economy is coming about and what's affecting what the Fed's decisions are going to be. So he wrote a book called Central Banking 101, and that's a really, really, really good read. Let's see. Are you giving opinions? What do you think of Tau, BitTensor? I'm trying to figure out my crypto journey. Well, let's just look at the chart real quick, because I think, that's one of the things that I like to do is, look objectively at what's happening, because unfortunately, I know that there's a lot of narratives in crypto. And, even myself, I've been very susceptible to these narratives. And unfortunately, right now, where we're at in crypto is that like none of that stuff really matters besides the impact that it has on people's decisions in where they put their money. Like, for instance, Dogecoin. Like, does Dogecoin really have to be, did it really have to go to like I think it got up to like an $80 billion market cap? Like, does it have that value in the world? I'm not sure. But did Elon Musk going on SNL and kind of like talking about it get it to go up to that level, right? Did people believing in this narrative actually get it there? It kind of did. And so I'm not saying that there's no fundamental use for Doge, to be clear. But I want to say that like in general, when we're looking at these different cryptocurrencies, a lot of the stuff is narrative driven. And so we have to be careful about like even like the AI wave has kind of been like the thing to keep an eye on this time. It's like, yes, you want to find some of the strongest narratives around that, and that might be a way for you to make some trades and make some money throughout the bull market. But getting attached to different cryptos and stuff like that based upon what they're doing on a technological level, I think can be a little bit dangerous. But From what the little bit that I've done on BitTensor, I haven't done a ton of research on it. I'm gonna be honest. It is a cool thing that they're trying to accomplish, and I noticed that a lot of people in my comments are very into it. So I'll do some more research on it, and I'll get back to you on it. I think I'm looking at the right chart. I'm just trying to find like the one that has the most data, because oh no, that's not what that is. Sorry, because it looks like, and maybe it just hasn't been out that long. Once again, I'm not a huge watcher of it, but like I'm just gonna be honest, from what I'm seeing right here though, like it's not super pretty. It's not super pretty the way that it's looking on the charts. And when it comes to altcoins, a lot of times I realize that like you really just want to look at the charts because anything else can be really distracting and can kind of distort your views on what may happen next. So like, you know, for instance, we've gotten a pretty nice lift off in a lot of altcoins throughout this recent time. Like let's look at Link real quick versus this, just as an example. Right, so Link has performed throughout this pushback up. Ethereum kind of made its all-time high, and Link didn't even get back to its 2024 highs, but it did make a significant push forward, whereas BitTensor did not. Now, you could say that that means, okay, well, now BitTensor has a chance to catch up, right? If it gets that kind of support in the market as well. But, you know, I try not to, the way I look at that is like you're going to have things that are laggards for sure, but then you're going to have things that are laggards because there's not as much demand. So just, you know, some things to kind of think about as we go through all this. Let me get back to some of these comments. Howdy, Keith. Howdy, y'all. What's up, Brand Blue? Welcome in. Market right now is a sea of red. Yes, see, I haven't been actually looking. So let's see what we got on the NASDAQ. Yeah, it's pulling back. Okay, so guys, I'm not trading today because I figured this was going to be a very volatile move, but and we also have to wait for Jerome Powell to come, or for me rather, I definitely would wait for Jerome Powell to come on as well to see what exactly is going to happen. So the reason we look at NASDAQ and the S&P 500, by the way, is because like whatever happens with those two indices is very likely to, you know, drag the rest of risk markets. And the big thing that I saw, by the way, for all my ICT people, when we first got that release is this huge SMT right here. Okay, so this is called in ICT concepts or SMC concepts. Please don't argue with me about that part. I don't really care. Is what's called a divergence in the price. We're just going to call it that. And so we had a major divergence between the price of the S&P 500 on the futures market and the price of the the NASDAQ 100 when we had that news release. And that right there, okay, puts us in a position to say, hey, yo, there's something going on with larger institutions. Look, and this goes way back further. So this is back to 15 o'clock on Tuesday. So technically the SMT is like all the way back there, but we're not going to be nitpicky about it. That is a sign that there's some sort of a potentially, at least there is entities with larger amounts of capital that can actually push these markets around, making a move there. There's something happening there, right, that is coming from a larger funding source. And in this particular situation, it's that there was a specific divergence in which one of those two assets went higher than the other. And it's just a way of kind of looking. This is all ICT stuff, right? So I'm trying to teach it, but I'm really also just trying to tell you how I use it. This essentially tells us that there's a sponsored move that may go in this direction. And as I pointed out earlier, we have all of this liquidity right here. And in ICT, we call this trend line liquidity. And the point here is that you have all these swing points, right, where people are putting their stop losses. Okay. And people are putting their stop losses. All these people are in profit, right? So for instance, as a market maker, right, I might want to go and actually provide for anyone who wants to buy. Then these are great places to go and buy because there's a lot of people with sell orders right there waiting for it. So, anyways, not trying to go too deep into that. Unless that's stuff that you guys want to learn about, you can definitely let me know in the comments and stuff like that. But anyways, yeah, I do trade ICT concepts, Arjit. 6 years ICT. Let's go, man. I ain't trading nothing today either. I feel bad for people who still refuse this technology. There are as many people with crypto as there were people using the internet back in the 90s. It's nuts, and it ain't hard to tell where it's going. Totally agreed. Yes, check out the huge divergence on S&P 500. Yep. Is there a way you can turn captions on? I'm in class. I'm trying to pay attention to both. Dang, dude. Let me see. That's so awesome. I'm not gonna lie. Uh, I love to hear that. Definitely pay attention. Pay attention in class, kids. No, I definitely would have been on the same type of wave when I was in school. So, let's see. Stack BTC and buy the dip. Nice. Profitable. I've been profitable, I would say, since the beginning of this year, pretty much. I've been taking it a lot slower. I had like a really good year last year, and then this year I realized I needed to kind of like slow down if I was going to be more consistent. So, not that long. It took me a full year to even get to where I could properly even be profitable at all. And now it's like I'm refining and continuing to invest in myself and coaching and stuff to make sure that I can like fully fine tune that and make it a proper part of my journey. Funny comment, yeah, in class, yeah, that's mad funny. H bar, dude, I know. Trust me, I actually this morning started doing more research on it to make sure that I can properly give you guys a good breakdown of H bar. But we can also look at it real quick if that's what you meant, because I'm very known to overanalyze. Okay, so here we go. H bar. So one thing that I want to say when we looked at like how Link, let's break this down from the roots of what's happened here. So Ethereum, all right, it moved up. Let me zoom out. I'm too zoomed in. It made its all-time high finally after a very long time of not doing so. People had lost their minds. Guys, this pullback right here was brutal. It was brutal for Ethereum. It was brutal for all of altcoins. And this was, from essentially throughout the tariff talk. All right. Brutal. But finally, ETH kind of like recovered a little bit and then bang, pushed off. And then these past few weeks, or like a month ago now, I guess, yeah, the beginning of August, it finally came up and made this all-time high where everyone in here was like, ETH is done. It's never going to come back. ETH will never make a new all-time high. And people were selling. I was having calls with people. They were like, I'm selling my ETH right now. Like, I can't do this. And all the people were talking smack about the dev team and how it's dead and everything. So it was kind of wild. Play some Alicia Keys on the piano real quick. Let me get back to you on that. H bar slept on, so I definitely understand. So the point here I was trying to make, was that Ethereum finally made its all-time high, and it looks like hopefully we can actually get a real push off and create some real movement there. But during that time, right, altcoins got hammered when it came down, and a lot of stuff isn't necessarily recovering now. If we look here at H bar, it actually did recover very well. Like, it didn't make its new all-time high, but it did recover pretty well. It still pulled back a little bit after I think the Jackson Hole thing is around what this is right here. But it is at least kind of holding up a lot stronger than most altcoins throughout this other pullback that we've had. Let's see, what else could we look at to compare? So HBAR doing well. Obviously, the fundamentals of that are fantastic. It's just one of those things where, once again, I try not to get too caught up in the narratives of the technology. We really have to, as it stands, for me, I'm going to have a percentage of my portfolio that's allocated toward specifically long-term technological ideas and concepts that I really believe in. And then I'm going to have another part of my portfolio that I'm going to more fluidly move around with as we go through market cycles, right? And for some people, they're going to trade. I'm not necessarily going to be trading my crypto. That's not really what I do for the most part. But, here and there, we'll put on some trades and do stuff like that. But it's not really something that I put a whole lot of my time or my income on at this particular moment. But in the bull market, it's definitely a good time to do it. So AVAX is next to run. Look at the chart, Keith. Okay, word. Ruse 32 said. Let's look at it. Okay, so what I would say here is it's tough. This is wild, guys. This is so tough. We saw how in 2024, right? AVAX in early 2024, it made a nice run up, and then it took a huge hit. And then what happened? Throughout all of the mania, right, in late 2024, right, when everything was going crazy, XRP was going crazy, Bitcoin was making 120,000 or whatever, what did it do? It failed to even break past that 2024 high. And I'm not talking bad about this. I'm just trying to express the sentiment. And then what did it do? It went down lower than this low, right? And then hung out down there for quite some time. Like, that is brutal for anyone who's expecting to have an alt season or to have any big gains throughout this bull market, because you got to think Bitcoin, right, is killing it throughout all of this time, and we're just like getting crushed in here if you're an altcoin holder. So I do see that it's starting to poke its head up at this moment, and if it wants to catch a bid, then it's got some work to do, right? It's got some major work to do, even just to get back to this 2024 high. So another example of just how brutal this alt season or altcoins have been to hold throughout all of this, right? Like Bitcoin, on the other hand, like let's just take a quick moment. Like Benjamin Cohen, I think is what he calls himself. Like, look at how Bitcoin has been performing throughout all of this. He's like, guys, like stop trading altcoins. Like Bitcoin is the winner, and it tends to be the one that outperforms over everything. So let's see. You like the XRP chart? You know, I've been ignoring it. Let's be real. Let's go ahead. Let's look at the XRP chart. Look, listen, guys. It's beautiful. What else can I say? Let's try to get some more data, though, real quick, because for some reason I don't have my data there. What's up with that? Why? That's weird. Oh, because they had delisted it. Oh, wow, y'all, that's great. I was like, why don't I have my XRP data on the chart? Dude, it's because they delisted XRP on Coinbase. And then they finally put it back in 2023. Wild. Anyways, all right, let's go to someone who did not delist XRP when they got hit by the SEC. Okay, cool. So this run up that happened in late November 2024 or in late 2024 was massive. Okay, and it's like nothing else was really doing this at that time. And now since then, it's been consolidating pretty hard almost this entire year. Right? Let's be real. We had a little bit of a head poke up to create that new all-time high, or some are saying it didn't really hit its all-time high. I'm of the idea that technically 384 was more like the all-time high. And then we had this major pullback as well, right? So altcoins have gotten hammered, but the thing about XRP is that it performed so well during that time that this actually was still a huge run up, right? From down here in 45 cents. So yeah, you're down 50% from that high, but in reality, you were up so high compared to everything else, right? So for instance, like AVAX basically went down and took out these lows during that pullback that it had during this time, if I'm not mistaken. And now it's starting to also push back up again, and it's holding somewhat strong in this $3 range. I'm not going to be surprised, guys, if we do have to come back down in here. But this is an extremely strong price action for looking for new highs. So XRP looks super strong, if I'm being super honest. You know, I know there's a lot of haters. I know there's a lot of lovers. But hey, we're looking at the charts, and the charts are saying not only is this asset performing well, but it's outperforming a lot of the other altcoins in the market. So something to keep in mind for sure. All right. You guys are awesome. I'm super grateful to have you here. Anyone who's coming in, we're kind of just like going through some charts. In fact, I've been getting so caught up. It's time to tune in. So we're gonna switch over to the FOMC meeting in just a second. We got 2 minutes until Jerome Powell starts speaking. So I'm super grateful for everyone who is here. Thank you for tuning in. This is awesome. And yeah, we'll keep it going and listen to what Jerome Powell has to say. So we're getting some mixed kind of feedback from what's happening with the indices here. So keeping that in mind as we transition over to the Fed meeting. Now we're still a little bit early, so looks like we got another minute until then. I'll look at some comments and see what you guys are talking about. This has been really cool. Super grateful for you guys being here. This is awesome. All right, Keith, you the man. Thank you, Chillax and Destin. You are the man. It's time, King. The live's about to start. Yeah, I finally figured that out. Nothing is random. Yeah, Arijit. Yes, sir. Keith, you look at Wormhole. I haven't been looking at Wormhole. I understand it as a bridge, though, right? Okay.
Zaxby's put the lemon pepper.
Oh, and then I got to know if you guys are hearing this stuff in a second, too, so we will make sure that that is the case. Okay. Let me see. Yeah, I think you guys can hear that, but you'll let me know in the comments. I know there's not anything really playing at the moment, but Mahir, yes sir. What's up, man? Alex, Yes, sir. We are ready. Deadpool groovy generational longs on Nasdaq. Oh my goodness. Oh my goodness. XRP going to the moon. We can hear. Fantastic, fantastic. Let's see if this pushes market up, if it keeps momentum. I'm gonna pull up my second. Oh, wait a minute. What's going on? Okay. I don't know what happened there. I'm gonna delete some of my tabs because I might be overdoing it. Yeah, can you guys see the podium and stuff? Have you already gone over channeling? I briefly touched on it. What's the move, bro? Should we buy and hold or sell? I'm new to this. Mr. Easy Dimes, it's not that simple. Yeah, but sometimes the screen turns white. Okay, yeah, I need to figure that out. That's problematic. Yeah, see, I don't know what that's about. I'm seeing it myself as well, dude. I might try to not full screen it because I think that could be a part of the issue. So yeah, you guys have to bear with me as I figure out some of the technicalities.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time.
They went straight into it.
I believe the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
It's certainly possible. We have begun to see goods prices showing through into higher inflation. And actually, the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And it's also possible and that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Colby Smith with the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off, and that tells you that it's time to take that into account in our policy.
The SEP, once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since really since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
I think a follow-up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal. So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is, it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, You'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and people they're making their arguments, and we're having a great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
They won't let that go.
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that, and it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data; it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So, as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter, and I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that. You see minority unemployment going up. You see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation that shows you that
So we're taking a hit.
The labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment.
The AI build out,
how long that will go on, no one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So, that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat.
Oh, you talking that smack.
He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve system and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to to always trying to do better.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
I'm excited.
So there's great uncertainty around that. I think my view, which is also a bit of a guess but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college, and yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down, and so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, I mean, analysts have different views, but we think it's contributing, 0.3 or 0.4 or something like that to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then some of, the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really. The only way for any voter to really move things around is to be incredibly persuasive, and the only way to do that in the context in which we work.
Yeah, he's talking much longer than normal. It's usually
really
30
strong
minutes,
arguments
and that's
based on the data and one's understanding of the economy. That's really all that matters, and that's how it's going to work. And I think that is the way the institution. That's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you heard about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor
Somebody
market.
Get this man off
Whereas
the
we
podium.
could still say,
He's not
and did
supposed to be
say
there.
in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, those are our two equal goals. And you will see that there are a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Thank you. Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is. So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly. And that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point. And that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention. Follow-up, if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected, what we got earlier this week, I guess. And also we're getting, a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability
This is wild
issues
that
and
he keeps
potentially
taking questions. I'm not
hindering
gonna lie.
household formation and wealth accumulation for a segment of the population?
You know, housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply. And so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is,
I'm just gonna,
there's a deeper problem
here.
There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage.
So,
or a lot of places.
Nothing really is happening here on Bitcoin.
Enough.
Just gonna be honest.
For people, and all of the
NASDAQ
areas
actually
around
are ripping a little bit higher.
Like Washington, for example, are very built up, and so you're having to build farther and farther.
So that's
out,
been interesting to see.
So that's where it is.
And just a quick follow-up. During the last
it didn't move higher.
SEP press
It's
conference
in a
following
range,
the last
but
SEP,
from where I was looking at it,
that policymakers lacked conviction about
created
their
a really
projections,
nice
and I'm wondering if you still feel that way.
But definitely stayed out.
Forecasting is very difficult even in
placid
times. And as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Looks like it wants to, potentially go lower. Silver's hanging out, not too much of a change.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, why reduce the size of the balance sheet?
I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think this default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate, and I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities, and I would say those are not elevated right now.
Okay, I think I'm gonna have to move on with my day in general. So, I'm gonna, kind of stop him there and just kind of do a quick recap of what we've seen in the markets. I appreciate everyone who's kind of sat in for this. I took a little bit of notes in the beginning to try to digest a little bit of what he was saying. So, let's recap a little bit of what we heard from his comments earlier. So, inflation is elevated. He acknowledged that at the very minimum. He kind of also started talking about the fact that there's this sticky inflation versus the one-time price elevation. And I think, let me see exactly what I noted on that. He was saying that inflation actually could be more persistent than he had previously kind of noted or talked about. And he doesn't want that ongoing inflation problem. So, he's acknowledging the fact that he's clearly stuck in between both of these dual mandates of maximum employment and steady pricing. So, what I liked, or what made sense to me about what he said, is that this is like a risk management cut. And then Alex, in the comments, I saw you say how, if he cuts by 50 basis, if the entire Fed system, the Fed board governors decide to cut by 50 basis points, then at that point, that's going to signal that there's something really wrong, right? So they're trying not to kind of take an overly aggressive approach to what may happen next with their rates, but at the same time, slowly ease up on the conditions to make sure that the labor market doesn't get too out of whack. So let's see here. I don't think policy needs to be drastic. Yeah, and another thing that was super interesting to hear is how, rates over the past 5 years, we've seen them go up from 2% or whatever to 5% or whatever it was, and then all the way back down to 0, and it's just been crazy. So what it was is whatever rates were right back in 2019, and then in 2020 when we got them all the way down to 0 basically, and then oh my goodness, I'm just typing stuff, and then we got the rate hiked after that because inflation was getting out of hand, and they wanted to hike rates to slow down the economy, and then we've also precipitously fell since then. Oh, come on. I think it's from not the New York Bank, but St. Louis. So you guys aren't seeing my screen. So it's been super drastic, right, in this region right here. We were chilling out, went bang, way down, and then bang, way up. And he's basically saying, like, all right, like, we're going to calm down here. We don't really need to have that drastic of a change in our policy. And so they're trying to keep things a little bit more smooth right now so that people don't react as well in a way that could be adverse to what they want to see. Obviously, the stock market is doing very well. We'll look back at the charts over here in general, right? Not necessarily in this exact moment, but in general, markets have been doing very well. And so they're trying to probably keep things like that from being a huge issue to markets, which then can turn into issues in the economy, right? So another thing that I wanted to touch on that he said was, he mentioned that we're in a low hiring environment. And I noticed that some of you guys kind of called that out. You're like, really? Because someone said, like, we literally saw a layoff today. Had one of his, I think, friends had like a layoff meeting. I'm sorry if I'm misquoting you there, but and in general, guys, like we all know that, you know, things aren't really looking ultra bright in the job market. You know, if you talk to young people, if you talk to people who have kind of been on the path of trying to, you know, do the right thing and even go into tech and, like, you know, pursue that specific kind of route, even it's not super pretty. Yes, he's saying, he's acknowledged that some of this has to do with technology and AI, but some of it is not. Some of it's more structural. And I think that's fair to say. So anyways, those are kind of the major things that I thought were interesting there. Alex, you know, you pointed out, you know, we're not going to cut rates super aggressively. And then let's quickly look at the FedWatch tool, because we can see that we're still expecting another 50 basis points. It looks like the market's expecting another 50 basis points by the end of the year. So for the December meeting, right, because you can up here, you kind of choose which meeting or which time frame you're looking at. We would be looking at a 350 to 375, which is actually, there's an 81% chance for that, which is actually, I believe, my goodness, am I tripping? Yeah, so 425, so 75 basis points by the end of the year is what is being priced into the market at this exact moment. But yeah, first off, I just wanted to thank everyone for hopping into this live stream. This was a lot of fun for me, and I'm definitely going to try to do more of these more often. So I appreciate all of your engagement and for being here. I think we'll try to find some excuses to do this. But yeah, this was fantastic. This was a lot of fun. I'm going to have to move on. We got some of the things that we have to look into for today. But this was awesome. And guys, be sure to like this stream if you're watching. And also be sure to subscribe to the channel if you're new here. And other than that, I will see you guys very soon. I appreciate you guys for tuning in. Peace.